Thank you for joining us. I'm Sonali Basak. I'm a financial reporter for Bloomberg Television in New York. We have a panel from all over the world today. We have Amy West, Managing Director and Global Head of Sustainable Finance and Corporate Transitions at TD Securities. We have Sean Kidney joining us from Australia, co-founder and CEO of the Climate Bonds Initiative. And we have Deborah Ng, Head of Responsible Investing at the Ontario Teachers Pension Plan. So major Canadian investor. Thank you, all three of you, for joining us. I think one good place to start is by measuring the impact. There's a lot of talk about green initiatives rising on the mind of investors, but if we're looking at how much that translates to in dollars, what does that mean? And maybe, Sean, you can get us started there.
Well, I mean, the thematic market, which is bonds where the proceeds go towards addressing climate change or addressing social investments or sustainable investments or related, which are the daughters of green bonds, if you like, is booming. You know, we had something like according to Bloomberg figures, something like 760 billion of issuance last year, I think it is, and we are sitting at about 1.7 trillion outstanding. The green bond market, which is the area I most intimately work in, is sitting at about $1.1 trillion outstanding at the moment. So it's not exactly huge compared to the overall bond market, which is 100 trillion, but it's pretty good and growing fast. What I'm going to say is the investor demand is extraordinary. The level of oversubscription for these thematic bonds is way higher than normal bonds. And when I speak to my investors, they simply can't get enough. Their asset owners are telling them they're interested in this sort of thematic portfolio. And this is washing over, by the way, to equities and other instruments as well. So it's an exciting time to be in it, which is weird, right? We've just had a brutal pandemic. We've just had a collapse of economies in some places. But there's a story there. People are realizing that the capital with purpose story is a story of the times.
Well, that's interesting. I'm wondering, Amy, if you could weigh in there on, what do you think the pandemic has done to really add to this conversation about ESG? Is there a link to the two?
I agree with Sean's comments and the question. For those of us involved in the markets, I have to be honest, if I said there wasn't a bit of uncertainty and unease as the pandemic set in, what would this do to what we still talk about as a bit of a nascent market? And as Sean said, the ESG markets are still much smaller than the overall debt markets. And we hadn't been through a systemic financial shock since the financial crisis, really in earnest. And so this was the first time since this market is, I would say, come of age to have that happen. And in that context, I think that I was blown away by how positive the response was to this type of thematic investing. We saw more transactions get done, and in particular, social transactions. Social bonds were 7 times higher in issuance levels last year, 2020, than we'd ever seen before. And so there was really a response from the global investor base that this wasn't just about doing the right thing, but this was an indicator of success. You've seen it with some recent articles from institutions like BlackRock, where we saw outperformance of a number of the sustainably focused funds. And if you look at the UNPRI numbers from the end of last year, there's more money being managed in the world today through a thematic lens than there's ever been before. I would actually go so far as to say that the amount of money that's not using ESG is rapidly dwindling. So I do think this is here to stay, and I do think we'll continue to see more focus on it. The pandemic, in my mind, only really helped to crystallize ESG as a material financial risk.
Well, that's interesting. And Deborah, maybe we can bring in an investor's perspective here. ESG is a broad category. And Amy brought up a great point about the social bonds, for example. When you're looking at this category, how do you kind of divide and conquer among the E, S, and G elements of it?
Yeah, I mean, that's an excellent question, and one that I come across a lot. And we've always been trying to sort of say, how do you ascribe, how much performance do you get from looking at ESG factors or looking at ESG investments? But the fact of the matter is, it's exactly that there's so many different elements and types of investments that are wrapped into sort of that ESG header, that I think you really need to break it down and think about, where does the plan, for us as investors, where do we want to have impact? Where do we want to invest? Where do we see as the greatest opportunity? Right? So from the environmental side, we're seeing a lot of opportunities really on decarbonization technologies, and that's a huge area of focus for us. On the social side, it's really about maybe positive impact. We're thinking about issues like inequality and education and investing in those areas as well. So I think I think investors are getting clear about the ESG themes that they're going to be looking at versus trying to sort of say, hey, we're going to allocate the ESG broad.
So one more note on social here, Amy. When you're saying that more people are looking at social bonds, what does that look like? Where does that money go?
I think that the difference between the traditional, and Sean said it right, green markets per se, which were environmentally focused use of proceeds transactions, the social category is much bigger. It could be a number of social initiatives, from things like affordable housing all the way through to the response to the pandemic. Healthcare spending was obviously a significant portion of the focus in the past 12 months. And so social bonds really pick up categories that are, again, not environmental, but we know have real societal benefit. And that's something that up until now, because it's a little more difficult to quantify impact, had been underrepresented in the ESG markets. Up until last year, we saw green bonds issued at about a 3-to-1 multiple to social bonds. And the reason is that we had a lot of metrics that were quantitative, that we could rely upon for very credible impact metrics on the back of a green bond. We issued a green bond and here's the impact. We can measure that in environmental terms. On social, it's a little bit harder. It's a little bit less clear. And so what we saw this year was really, and I think for those of us on the issuer side, on the sell side, it was comforting to see the buy side, to see investors getting comfortable with these social transactions coming to market.
Well, let's bring that then back to Sean here, because talking about social versus green bonds, when you speak to investors who are thinking about ESG and want to put their money to work in impact, right? Do you feel ever that you're competing against these different forces and interests? And what are the conversations like that draw your clients into green versus other places?
Well, people are interested first in their capital being used to do good while doing well. And one of the things we've proven over the last few years is that people that invest in these things actually do better than the mainstream. ESG works. That actually the extra data points involved give you a greater prediction of sustainable returns. Now, the green and the social are part of that. The EU issuance of social bonds, some 30 billion AAA bonds, is actually working well for people. In the German market, where the green bond has been issued at a slight discount to the primary market, they're actually performing 8 basis points better in the secondary market than a vanilla bond. Investors know this, investors see this, and what's more, in the downturn, they hold their value. So they're a capital retention tool going forward. So this is one of the things driving it, but fundamentally the customers of investors are saying, why can't I have my capital doing well while doing good? I'm hearing I can, and investors are responding, really. We have BlackRock responding to this in terms of climate change recently, of Larry Fink's various letters on this topic. But they're not the only one. State funds around the world have been doing it, and it's because it is doable. We can make money while doing good. This is what we prove. Green bonds have proven the point.
I'm so glad you brought up the financial aspect, right? Because a lot of the questions around ESG is how to place the money and how to make sure that there is an impact as well as a return. And as far as another point of measurement, right? To make this market advance further, what do we need to be measuring better than we have had before?
So one of the things we've talked about is the need to understand, make it easy for people to understand what are the right kinds of investments. We've done that with a thing called a taxonomy. It's now become part of the European regulatory landscape to bring in a taxonomy of definitions for sustainable investments, guidance. So look, you need to know that a solar farm is in. You don't need to do a complicated report on why a solar farm is in. You need to know that green buildings of a certain sort are in. You don't need to know you don't need to make the justification yourself about this. We're trying to make it easy for the market to go forward. And critical to all of this is this idea that when we get to, in the green space, when we get to green investments, we must be addressing the Paris Agreement. It's a clear underlying requirement of the whole market. And in the social space, it's actually related as well. You know, the European the European Commission's $30 billion of SURE bonds looking for funding unemployment relief in the European Union are linked both to the recovery of the pandemic, but also the building of resilience. The 750 billion European Resilience and Recovery Fund demands that member states actually look at the arguments of what they're doing to create resilience. So, you know, guidance is becoming the norm. Central banks are adopting this guidance. Christine Lagarde at the European Central Bank is going to do green quantitative easing based on taxonomy. We're making it easy. We're making it.
That's a great point to bring in Deborah in, because when you look at your investment opportunities around the world, right, you do see more governments and central banks starting to take action, starting to work together, maybe not in some cases. How does this change your calculus? What do you need to see, and how does it make it difficult to invest in some areas versus others, like the United States, for example, that has changed its course on the Paris Agreement in the last couple of years and maybe reversing now?
Yeah, I mean, that's exactly the right question when we think about it. Ontario Teachers, of course, is a very long-term investor. We have members with pensions that are going to, they're going to contribute to the pensions for 30 years. They're going to be retired for 30 years. So we're looking at over a 60-year horizon. And so while we've been heartened by the amount of countries that have been committing to net zero, I think 50% of the countries by GDP and by emissions have committed to net zero, that just gives us a lot more ammunition when we go out there and look for sort of investments in climate technology. And then where the risk comes, of course, is not being able to rely on having stable long-term climate policies. So I think it's a bit of both. Like we're very heartened to see the countries that are committing to it, but as a long-term investor, we also have to consider, the likelihood for a country that we're investing in to change their policy, to scale back on a climate, and because that is going to impact the value of our investment.
Amy, I love your opinion on this too, because for a long time, and I covered investors and banks for a number of years here at Bloomberg, and over they keep saying Europe just has it better. They've been more consistent. This is a much bigger market in Europe. And so when you're talking to investors, does that mean what does it mean for them to have that kind of lead? And what would it take for other regions to catch up?
It's a great question and an interesting one, right? I think that the point made by Deborah was a good one. Consistency of regulatory support and the political will to have that consistency is something that we haven't seen for the past at least 4 to 5 years in the U.S. And so I think that from the perspective of on a going forward basis, the U.S. rejoining the Paris Climate Accord and COP26 coming up are going to be transformational. But interestingly, from my perspective, we already saw a lot of interest out of North American investors in ESG for 2 reasons. One was a lot of the global investors that happen to be U.S. domiciled funds already are significant investors in other markets where this is the law of the land. And so if you're a big global investor, you don't traditionally go to the jurisdiction with the most lax requirements and implement that policy. You usually implement the more stringent policy. And once you understand as an investor how to implement, it gives you a competitive advantage. A lot of investors would argue that, and Deborah could obviously expound on that. But I will say that, in my opinion, in the US, I think that the investors that engaged in ESG have not done so because of regulatory reasons. They've done so because of capitalist reasons. And in some ways, I think on a longer term scale, that will position them well for success. It's rare that consistently you see governments lead innovation. The private sector throughout history has traditionally led on innovation, and I don't expect this to be different. So it's fabulous that the consistent regulatory environment in Europe has created a breeding ground for the private sector, but it's a careful balance between doing that and stifling innovation. And so I think that that's going to be the next iteration here. And to answer one early question from you, if I can just say one more thing, I think consistency of reporting, and if regulation requires that, would be a huge boon for the market going forward.
Okay, so I will get back to reporting in a second, but on the vein of reporting, when you think about it, and this is the road to net zero. This is what can we do to get to zero faster. Sean, where do greenwashing concerns fall for you? I mean, what are some examples of things that might concern you as you do your job every day?
Well, I want to say first that there isn't really much greenwashing. We don't have the intent here. The only greenwashing I know of for certain was a Syracuse, New York property developer in 2008 who just got a green bond tax credit and then decided, hey, I got the money, I don't need to do anything. That's about it. In the meantime, people have been following through. What we mean by greenwashing is more that people make claims to environmental benefit, and those claims are disputable. So we have a lot of that. If a gas company says, I'm going to reduce emissions by 20%, hey, that sounds good, right? Well, actually, if you're looking at what we have to do to achieve the Paris Agreement, it's not good. You need to get much steeper reductions in emissions in the gas sector to meet the challenges of the Paris Agreement. So that kind of discussion and understanding about what are the right investments is what's needed here. If Suncor in Alberta decides to pursue energy efficiency and reduce its emissions, is that a good thing or is that not a good thing? That's the question. Actually, the challenge is we've actually got to get Suncor to shift to bitumen production and away from combustible oil to make the transition. So this year, you'll see a lot more detail coming through about frameworks for investors to review the environmental credentials of what I'd call transition industries, oil and gas, steel, cement. We're pretty clear on things like buildings and renewable energy and so on, but we've got to tackle the tough sectors of society and show the pathway to go through. And that's how we address this, which is actually a lack of understanding.
Amy, do you agree or greenwashing your concern?
I mean, I think, it goes back to the reporting, right? As an investor, we need to have transparency to understand if companies are undertaking greenwashing, right? And I think, Sean brought some really good examples of companies that have made commitments. But, at the end of the day, it comes down to performance. It comes down to the actual numbers you're able to achieve, right? So you can set yourself a 20% target or a 50% target, but if we're not seeing those numbers in your emissions going down, then as investors, we're kind of going, well, we're going to be a little bit more skeptical about, their transition plans. So I think, reporting is absolutely key. We need to have this information in order to make that decision. It needs to be consistent because I need to be able to look at Suncor. I need to, a lot of the EU taxonomy is really based on sector norms. It's based on what is the best technology that the sector can do to achieve decarbonization. So in order to get there, you need to have all the companies within the sector sort of providing that reporting so that you can kind of take a look and say, well, how does this company perform next to their peers? And are they doing better or worse? Can they do more? So I think it's going to be up to reporting and verification of those numbers and performance.
Amy, it's funny. Reporting has been an issue as long as I've covered this. It's been an issue for so long. And I'm wondering, when you look at this year ahead, and if you could create an actionable way to make this a fixable issue, a few things that you would need for reporting to be clearer across borders. What do you think the big innovations in reporting will be this year?
So it's interesting. I think that we've had a lot of support in the green, social, and sustainable bond market for harmonized impact reporting. And the handbooks that have come out from ICMA have gone a long way in standardizing that. I actually think the area that we could improve the most would be on actual corporate sustainability reporting. And I think that that's going to be increasingly important given the uptick in interest around sustainability linked debt offerings this year. Because suddenly it's not just about what the proceeds of that specific bond are going to, but it's holistically, how's the company measuring forward progress? And so institutions like the GRI, SASB, TCFD, these are going to become really important because in these reports, it's going to allow investors to, on a more apples to apples basis, compare what companies are doing. And we all are aware that as a company continues down this journey to net zero, there's an argument to be made that your first few years in this journey are going to be easier in some ways than as you continue this journey, because you're going to be tackling some of the easier to approach projects and initiatives. But just because your percentage improvement goes down, that doesn't actually mean that you're not doing as good of a job. It just means that you're tackling potentially some of the harder problems down the road. So I think that alignment to some of the global standards will help a lot in terms of what investors are looking for and being able to compare across the market.
So that leads me to my next kind of question that I think about a lot. And Sean, are we moving fast enough? We're talking about the road to net zero. I see a corporate announcement a day about it, right? Are we moving fast enough?
Well, patently not. I mean, that's why we're getting climate impacts around the world now. That's why the Arctic and north of Canada is warming at an unbelievable level. And in fact, if you look at the cold that we're experiencing in the US at the moment, it's because the Arctic is too warm and is pushing cold air down. That warmth is really scary. And we're not moving fast enough. We've got about $1 trillion going into the right kind of investments. It needs to be $5 to $7 trillion a year. So the scale we have to achieve is way above where we are now. Now, a lot of that will be redirecting capital flows. You know, if you're investing in transport, stop investing in freeways, invest in mass transit. Well, that's a post-COVID story, not so good in the middle of COVID, but you get the idea. So absolutely right, long way to go. We've got green shoots. The good news is that there is capital moving, and we see the demand being unquenchable now for the kind of capital. The other good news is that we have countries moving. 110 countries have committed to 2050 net zero targets, and the US looks like it's about to on top of that. Now, we've got to deliver on that. Europe has also committed to 2030, 55% cuts. That's what the whole world needs to do. So the target settings are coming together this year in a way they were not pre-pandemic. But folks, we've got to do it now. We've got to deliver. And that's going to mean some very tough decisions about industrial policy. Don't get me wrong. This will create jobs, 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 and jobs. The kinds of investments we need to make in terms of shifting our economies will create a 30-year boom, in my view, because of the vast capex in areas where there are jobs. But we've got to get going. It's a bit like infrastructure in the US. We've been talking about it now for 8 years, and we're still letting the whole thing turn into a decrepit mess. We've got to get going and start investing.
So speaking of investing, we're getting this question from the audience now, and from an investor's perspective, what does a company need to consider when they're making a net zero commitment?
I'll jump off and say, is the change strategy they're looking at commensurate with what we actually need to do? That's the key thing. And it's hard if you're a company because you've got to shift your business lines, but there's opportunities. In the steel industry, for example, you need to be looking at a shift to recycling with electric arc furnaces and usage of green hydrogen. It's doable. Green hydrogen will be the same price as gas in 10 years' time. So if you get going on that pathway, you will be able to make the transition in a really solid time. In cement, there are low carbon concrete, same price, already being offered by Lafarge, Heidelberg, and so on. We've got to scale it up. We need the help from the government on procurement policy to make sure those things grow, et cetera, et cetera. So if you're a company, you look at what the envelope looks like and where you've got to change, and then you look at what settings you need to the system to make sure you can make the change. It may require you to talk to the authorities about energy policy or property policy as part of making that change. There's no doubt that the public sector working at the private sector has to be a theme of making this change going forward. But just remember, ambition, ambition, ambition.
So for Deborah, I want to get at this question in a bit of a different way. For a country with such a huge energy industry, right? How do you balance the road to net zero with that reality?
Yeah, I mean that is the question, isn't it? I think it's about long range planning, right? It's about thinking. It's about ambition. As Sean said, setting the ambition and then setting that roadmap, right? So understanding. How to get there, you have to map it out. Like we need to think about it, and we need to think about it in a way that is just and orderly, because this is going to be very disruptive for certain sectors. I think a lot of the, energy intensive resource companies in Canada, have been making progress. They have been, trying to sort of, make their operations more efficient, and it is very well regulated. Industry in Canada. So I think, they're taking steps there, but I think we really need to think about it as a country strategically, and then set that roadmap there. So it'll be very interesting, how Canada, has set its 2050 commitment, net zero by 2050. We're looking at our 2030 targets now. So, we're looking to see, what that's going to look like, and how that's going to be implemented.
And is there frustration, right? I mean, you act on behalf of policyholders, right, or retirees rather, at such a major retirement pension plan. Is there a frustration about moving fast enough, or is there a greater concern here about what the job outlook looks like as this transition happens?
Yeah, I mean, I think, how fast this transition happens has a direct bearing on the pension plan and our ability to earn returns. We are a global investor. We are exposed to the global economy for a very long period of time. We can't, we don't have the luxury as a company to sort of say, hey, I'm going to, I can manage my own operations and get to net zero as a company, but as a pension plan with 3,000 investments, we have to get all of those investments to net zero. So for us, the time is of the essence. We have a lot of work ahead, and every investor needs to sort of get started on that pathway now, because if we don't make net zero by 2050, we are going to have some serious problems ahead of us.
And Amy, I'd love you to answer this question too, because you are in talks with investors all the time. What do they need to see from a company's, from an investor's perspective? What do companies need to be doing as they make these commitments?
Well, I had the benefit of also listening to two strong answers here, but I will say I think that transparency is going to be key from the issuers to the investors, because how we actually calculate not just scope 1 and 2, but scope 3 emissions is largely undefined right now. There is no agreed upon methodology that every company is going to do. And I think that some of our most informed investors and issuers both know this. And so transparency around how you're calculating your emissions, what that looks like, is going to be key. I also think it's an understanding that not every single industry today is going to be able to transition. And on the other hand, there's some industries and sectors that will be able to probably go net negative, that could actually go the other direction. And so this is going to take all of us working together. I'd agree with Deborah's comments, because I work for Canadian Bank. We obviously are very active in Canada as well as a result, but I find our energy clients some of the most informed and aware of the change coming. And I think that when we look at net zero, how each industry approaches that is a little different. And so with investors, I think asking for transparency, asking for clarity, the requests for information, these are all reasonable requests that we should continue doing. This is where, again, that reporting comes in, so that we're all speaking the same language. And then you can actually have a coherent conversation across clients and across investments within sectors. I think that's how we're going to move forward. And really, it's not about stopping to bank or stopping to invest, in my mind, in some sectors or another. I think the days of negative screening are long gone. It's more, how do we figure out the outperformers from the underperformers in this transition?